Good morning. Hi. Thank you so much for joining us. I am Amy Raskin, the Chief Investment Officer of Chevy Chase Trust. We have an exciting morning planned, so we're glad that you were able to take time out of your busy schedules to be with us today. I'm going to kick off with an overview of our latest thinking about behavioral biases, which we believe are having an outsized influence on asset allocation decisions today. Then I'm going to describe our four-step investment process and touch on our current macroeconomic investment outlook. Okay, so now I'm going to start by revisiting a scary time. On March 6, 2009, the S&P index bottomed at 667. The title of the Wall Street Journal's Money and Investing section that day was "How Low Can Stocks Go?" Prior to March 2009, the last time the S&P index was below 700 was in 1997, 13 years earlier. A decade of market gains was erased in 17 months. During the week the market bottomed, Goldman Sachs published a research report warning the S&P could fall as low as 400. That would represent another 40% decline from the 667 level. It was a time of panic and chaos. During the first quarter of 2009, U.S. investors pulled $800 billion out of U.S. equity markets. But by the end of the year, the market had rebounded 69% to 1,115. And of course, as we know, it didn't stop there. Just last week, the S&P index closed over 2,540, 280% higher than the low on March 6, 2009. Including dividends, the total return generated by the index from the low point exceeds 300%. As we'll discuss shortly, much of the money investors took out of the market in early 2009 was never reinvested. So unfortunately, many people who got out at the bottom have not benefited from this powerful rebound. As we wrote about in our most recent quarterly letter, despite the relatively steady 8-year equity rally, the complacency and euphoria that typically surround bull markets just doesn't seem present today. I'm going to discuss a few reasons why this bull market has been different from some of those in the past. My comments will hopefully shed some light on current asset allocation dynamics, bond yields, and potential for further equity market appreciation. But let me start with a question. You have two options. In the first option, you have a 33% probability of receiving $2,500, a 66% probability of receiving $2,400, and a 1% probability of getting nothing. In the second option, you are guaranteed $2,400. So now if you can use your clickers and choose option 1 or option 2, which option would you prefer? Option 1, 33% chance, $2,500. Option 2, a guarantee. Sorry. Okay. This makes sense for everyone? Okay, I'll give it another couple seconds. I see some people calculating in their heads. Okay. Okay, let's go with the results. Okay, thank you. Most people chose option 2. And I've seen this behavioral finance question posed a number of times, and I've never seen more people select option 1. And here are the statistical results. Typically, this audience is smarter than most, but most people overwhelmingly choose option 2. And this is sort of interesting, right? Because in option 1, you only have a 1% chance of not earning a reward. 99% chance you're going to get something, and more people, and it's a higher expected value. But in behavioral finance terms, this is called the affection for certainty. Investors disproportionately select asset classes that they believe have no principal risk, even if the returns are subpar. Again, in this example, there's only a 1% chance of not reaping a reward, but even this de minimis chance is too much for most people. And the $9 differential is just not worth the risk. Currently, this affection for certainty is most evident in bond markets. Nominal short-term bond yields, or 2-year yields, are currently negative in Germany, Japan, Switzerland, and many other countries. In fact, globally, there is now $8.7 trillion of negative yielding debt in the world. People are literally paying banks just to guarantee the return of their principal. Evidence of this strong desire for certainty can also be seen in the U.S. bond market. Although nominal yields on U.S. government short-term debt are not negative, real yields are negative. Real yields are calculated by subtracting inflation from the interest rate. Currently, the 2-year bond yield in the U.S. is a little less than 1.5%, and the rate of inflation is about 1.7%. So the real short-term interest rate on U.S. short-term bonds is negative 20 basis points. Sorry. And the term premium has also dropped below zero. The term premium is the excess yield that investors require to commit to holding a long-term bond instead of a series of shorter-term bonds. The term premium is not easy to measure because it requires an estimate of the future course of interest rates over a fairly long horizon. Therefore, different people have slightly different measures of the term premium. But most agree throughout most of history, the term premium has been positive. Financial market participants required extra yield to hold a bond for a longer period of time. In Econ 101, this is called the time value of money. But today, the situation is quite different. Investors are so eager to lock in a long-term rate and have certainty that they are willing to pay, by this estimate, about 25 basis points for that certainty, rather than demanding compensation for having, their money tied up for 10 years. So now another question. In the first scenario, Leslie invests in Intel. During the past year, she considered switching to Google, but she decided against it. She now finds out that she would have been better off by $10,000 if she had switched. Mark, on the other hand, has invested in Google, but during the year he sold it and bought Intel. He now finds out that he would have been better off by $10,000 if he had kept his Google shares and not sold them. They both end up with Intel, and they both did not earn the $10,000, but who feels greater regret? So now you can use your clickers. Choose 1 if you think Leslie feels greater regret, or option 2 if you think Mark feels greater regret. Okay. You guessed it, okay? You're right. Okay, brilliant. Okay, here's the statistical report. Over 80% of people understand that Mark feels greater regret. And there's a behavioral finance term for this too. It's called regret aversion. People experience more regret from actions they have taken than from inaction. And since they regret the action, they tend to be slow to undo the mistake. After accounting for inflows and outflows during this 8-year bull market, U.S. investors have pulled $462 billion out of equity markets. So let me repeat that. The market has gone up 280%, and investors have pulled $462 billion out of equity markets. Companies have actually been the largest purchasers of their own shares. U.S. investors have, however, invested $1.7 trillion in bond funds. Due in part to regret aversion, we don't expect this dramatic reallocation of assets to change anytime soon. Regret aversion tends to elongate cycles. But the craving for certainty and regret aversion are not new phenomena. So why do they appear particularly powerful this cycle? Well, we're not psychologists, but our best guess is that this is likely due to the byproduct of our recent history. Let me show you this. Okay. Within the space of a relatively short time period, let me see if I can get this right here, we've had 2 severe equity market meltdowns in both duration and magnitude. This chart, we've highlighted all of the bear markets going back to the Great Depression in 1929. As you can see, there were only 5 years, right here, between the bear markets in the first decade of this century. This short of a time period between bear markets had not occurred since the 1970s. And since most of us did not have a lot of money to invest in the early 70s, for many that period is not top of mind. In contrast, the 1980s and the 1990s were exceptionally fruitful decades for equity investors. Almost 26 straight years of bull markets. Everyone thought they were stock market geniuses, and you had to really work hard to lose money in equities. We think the scars from the back-to-back declines beginning in 2000 and then again in 2008 are still having an influence on investor behavior today. I don't have my coin, but okay. So now for a third question. If I did have my coin, okay, I would flip it, and if it comes up tails, you lose $1,000. So who wants to play with me? Okay, I didn't think anybody would. It's not mandatory, but how much would you need to win if it comes up heads in order to play? Would you need $1,000 even money to play an even money game? Would you need $1,250? Would you need $1,500 or $2,000 or more to play a heads tails game? Okay, now use your clickers again. That's going to be my last question.
Is it one flip or multiple flips?
One flip. Tails, you lose $1,000. Heads, you win either $1,000, $1,250, $1,500, or $2,000. This is always an interesting question. We have risky people. Okay, we'll go for it. Oh, great. Thank you. Perfectly in line with the statistical results. About over half the people in the room require more than a double to play an even money game. And here are the statistical results when researchers gave this problem to randomly selected people. Over 90% of respondents required a premium to play the game. 70% still wouldn't play if the reward did not exceed the loss by 1.25 times. And what I find so fascinating is that 60% of respondents wouldn't play unless the risk-adjusted returns would result in a double. They needed $2,000 or more if the coin came up heads to deem it worth the risk of losing $1,000. So what this example shows is that people do not like to lose. Actually, they will do virtually anything not to lose. And in particular, they do not like to lose money. As one of my early bosses warned me, the only thing people potentially like less than losing money are the people who lose money for them. And once again, there is a behavioral finance term for this desire not to lose, and it's called loss aversion. Loss aversion means that people would rather avoid a loss than reap a reward. Research has shown that the feeling of losing and gaining the same thing is quite different. In other words, the negative feelings coming from a loss are much stronger than the positive ones coming from a gain. It is thought that the pain of losing is psychologically about twice as powerful as the pleasure of gaining. And money managers understand this. I was recently speaking with a colleague who's the president of a major competitor. I asked him how he was doing. And he said their private client portfolios have underperformed their benchmark for years now because they were and still are positioned for a downturn. So I asked him what economic data made him think a downturn was imminent. And he point blank told me that he didn't believe a downturn was imminent, but he said, and I quote, "Clients don't care if we don't match performance of the index in a bull market as long as they lose less than the overall index in a bear market." So I was slightly dumbfounded by his remarks, but of course he's right. As I just told you, people feel losses much more acutely than they feel gains. So if the market is up 12% and someone's portfolio is only up 8%, he or she is likely not that upset. They made money, I'm up, everything's good in the world. So you don't typically lose a lot of clients if you're up less than the market. However, if the market is down 12%, the client's already not happy, and if the individual's portfolio is down 15% more than the market, the client's likely really not happy, and they may even switch investment managers. But the problem with this strategy from a fiduciary perspective is that, as I just showed you, markets go up much more than they go down. So if you are always positioned for a downturn, you are going to dramatically underperform over time. And as our expert financial planners will tell you, if you don't fully participate in the up markets, it makes it much harder to withstand the down markets. And financial planners plan for down markets. As we learned from the past 2 recessions, it is virtually impossible to avoid them entirely. Correlations shoot higher, and there are very few safe places to hide. So we focus on long-term averages for planning purposes, but to achieve our objectives, we cannot always be positioned for the worst. Despite the tumultuous recent history, the S&P has been positive in 29 of the last 37 years. That's over 75% of the time. So by the way, I'm just going to interject a short public service announcement because I thought this was particularly interesting and something that I know I have fallen prey to recently. Marketing experts have a long history of trying to capitalize on our desire not to lose or to miss out. We've all heard phrases like last chance or limited time only in marketing campaigns, and we're likely somewhat immune to those pitches by now. But online shopping has taken this approach to a new level. Online retailers have learned to create a sense of scarcity by simply showing exactly how many items are left, or supposedly left. You might be shopping for a new pair of shoes, and when you choose a size and color, you may see a text pop up, "Hurry, only 2 left." This actually makes you feel quite anxious, and statistically speaking, you're much more likely to buy to avoid missing out. So the next time you see that warning sign pop up, take a deep breath, and know that you're being marketed to, and ask yourself if you really need the item and do you really need it now, because it's likely that the vendor will not run out. While being overly risk-averse is a behavioral tendency we try to guard against, we also recognize that risk management is a critical component of our job, and we want all of our clients to be able to sleep at night, and frankly, we want to be able to sleep at night as well. So in other words, we don't want to take excessive or undue risk. So over a long period of time, we have developed a robust 4-step investment process that we believe helps us identify and capitalize on investment opportunities earlier than our competitors. Importantly, it also helps us manage risk through both proper identification of where we are in the economic cycle and very careful and deliberate portfolio construction. The first step of our process is identifying and researching our investment themes. This is our starting point. It makes our investment process unique. There are thousands of public securities available for purchase in the world. Every investment manager needs a process to whittle down the investment universe into a manageable group of companies. Many firms use a quantitative screen. For example, they will look for stocks that trade below a certain price to book or price to earnings ratio. Others will limit their overall mandate from the get-go. They will label themselves U.S. large cap growth managers or small cap emerging market value managers. We use our themes to guide where we hunt for investment opportunities. This is really the heart and soul of our firm. Spencer will talk about this in greater detail in a moment, so I will quickly review steps 2 through 4 and then turn the podium over to him. I can't tell, okay, which one is bold, sorry. The second step in our process is our assessment of the global macroeconomic landscape. This helps us determine the weightings of each of our investment themes. Every week, we go through all of the economic data points that were released over the past 7 days. This helps us stay focused on the facts and minimizes another dangerous behavioral tendency called confirmation bias. Confirmation bias is a tendency for people to seek out information that confirms their existing opinions and overlook or ignore information that refutes their beliefs. Confirmation bias occurs when people filter out potentially useful facts and opinions that don't coincide with their preconceived notions. By examining every data point and focusing in particular on the data that contradict our working framework, we are constantly challenging our assumptions and asking ourselves where we could be wrong. These meetings are absolutely essential in identifying turning points in the macroeconomic backdrop. You've probably heard the adage, you can't time the market. And of course, if you're trying to pinpoint precise dates and times, that is true. Nonetheless, understanding where we are in the economic cycle should be a critical input in every investment process. Our work led us to increase our geographical diversification towards the end of last year and has helped us effectively shift between value tilts and growth tilts at appropriate times during the past few years. These somewhat subtle but impactful repositionings significantly contributed to our recent performance. We didn't exit or enter any new themes. We just reweighted our holdings to incorporate a slightly different economic viewpoint. The following chart makes it clear that successful investing requires more than simply analyzing corporate earnings. Market multiples vary dependent on the economic landscape. The orange portion right here of these bars show the impact changes in the market price to earnings ratio have had on overall returns. As you can see recently, changes in PE ratios have had a greater impact on returns than the contribution from earnings growth. Market multiples tend to rise when inflation is falling. They tend to decline when inflation is rising. Bear markets are almost always associated with recessions, and recessions are almost always predated by a rise in inflation, higher levels of unemployment, widening risk spreads, and a plateau or decline in corporate earnings. None of those conditions exist today. Somewhat counterintuitively, what's good for Main Street isn't always good for Wall Street. Slow economic growth keeps inflation and interest rates low. This is actually a good environment for equities. A pickup in growth, particularly at a time when there isn't much slack in the economy, as measured by the unemployment rate at 4.2%, could herald in inflation and therefore the end of the bull market. We are vigilantly watching for signs that a sustained pickup in inflation might be brewing. And now just a quick note on valuation, because we get this question a lot. Equity market valuations are high. There's no doubt about it. Currently, the price to earnings multiple of the S&P 500 index is about 21 times. On average, right? On average, investors are paying 21 times earnings for companies in which they are investing. The average PE ratio since 1950 is about 16 times, so we are notably higher. Inflation is also notably lower than the average inflation rate over the past 70 years. Inflation today stands around 1.7%, whereas the average is about 3.5%. Some people would make the argument that compared to interest rates and accounting for current levels of inflation, equity markets are cheap. Now, I'm not going to make that argument, but I am going to tell you that the relationship between valuation and next 12-month price performance of equities is just about zero. Expensive markets can, and more often than not, do get more expensive. Therefore, it's much more important to focus on the changes in the macroeconomic backdrop that will influence that PE ratio more than fret about current valuations. And we can talk about more of that in more detail in Q&A if you're interested. But the third step in our process is individual company analysis. The biggest issue I see with portfolios that are transferred into Chevy Chase Trust is over-diversification. Clients often transfer in portfolios with dozens of exchange-traded funds containing 50 or 60 securities each. In some cases, they have more stocks in their portfolios than there are in the S&P 500 index. Often in these instances, they are paying layers and layers of fees for portfolios that structurally have almost no chance of outperforming because they are just not sufficiently differentiated from the index. We've written a few white papers on a concept called active share. You can find those on our website. But the gist of the analysis is that you have to be different in order to achieve a different and hopefully superior investment results. Our portfolio typically consists of no more than 45 individual equity securities. This allows us to be sufficiently diversified from a risk management perspective, but enables us to outperform on a relative basis. Between 2/3 and 3/4 of the companies in our portfolios are direct beneficiaries of one or more of our investment themes. Stocks that have exposure to more than one theme typically have higher weightings in portfolios. Each security is covered by a Chevy Chase Trust research analyst. Bobby and Tap will provide specific examples of how our thematic research translates directly into stock selection. And this brings us to the final step of our investment process, which is risk management and portfolio construction. Again, let me reiterate, we want you to sleep well at night knowing that Chevy Chase Trust is managing your assets prudently. We employ some of the most successful and powerful quantitative tools to flag potential systematic and company-specific risks in client portfolios. These tools examine dozens of metrics such as earnings revisions and variation, free cash flow production, changes in accrued earnings and shares outstanding, short positioning valuation metrics, and hedge fund and ETF ownership, just to name a few. If a quantitative model is indicating that a fight is breaking out in one of our holdings, meaning that there may be a growing short interest as the share price is climbing, or the range of analyst estimates for future earnings is widening more than usual, we conduct a thorough review of our long-term investment thesis and the company's competitive positioning. If something has changed, we will likely take action by altering the position size or potentially exiting the security altogether. In addition to quantitative tools, portfolio construction is an extremely important part of our risk management process. We're fortunate as long-only investment managers. Our upside potential in each holding is unlimited, but our downside risk is limited to the amount of the position. In other words, if you have a 1% position in a company that we think can triple, the upside potential is 200 basis points, but the downside risk, if it goes to zero, is only 100 basis points. Now, this is an overly simplistic example, but for short sellers and hedge funds, the math works the other way. For example, if you had a 1% short position in NVIDIA in 2014 and didn't cover, that relatively small 1% position would have reduced overall portfolio performance by 800 basis points, or 8%. We use this asymmetry to appropriately size positions within client portfolios. Our most speculative companies, the companies that we believe may offer the greatest reward but also have downside risk, tend to have relatively lower weightings. Now, I'd like to conclude with an observation that struck me a few weeks ago while I was at the Washington Ideas Festival. I was fortunate enough to sit in on a presentation by Walter Isaacson. His new book is on Leonardo da Vinci. Isaacson discussed da Vinci's obsession with human anatomy. Da Vinci's notebooks contained thousands and thousands of pages of anatomical drawings. Colleagues at the time encouraged da Vinci to spend less time studying anatomy and more time painting. But da Vinci meticulously studied every muscle in the human body, including the muscles in the face. He understood precisely which muscles were involved in creating a smile. And da Vinci's seemingly unrelated obsession actually made him a much better artist. His knowledge of the muscles in the face helped him paint the most famous smile in the world, the smile of the Mona Lisa. Now, I want to be careful not to compare what we do at Chevy Chase Trust to the brilliance of da Vinci. I recognize that would be extreme hubris and my parents would be horrified. But I do think this story is relevant because we at Chevy Chase Trust spend a good deal of time conducting research that others may deem to not be directly relevant to specific security selection. You'll see examples of this today. However, we are confident that this research gives us a unique perspective and makes us better investors. I've long said investing is as much of an art as it is a science. There are a lot of very smart people in our profession. Any systematic advantage is competed away in months, if not weeks, if not days. But as da Vinci proved, a deep understanding of a seemingly unrelated science may be exactly what is needed to create extraordinary art, or in our case, extraordinary investment results. So now thank you very much for your time and attention. With no further ado, I'm going to turn the podium over to Spencer Smith, our Director of Research.